The search for uncorrelated alpha pushes quantitative developers toward highly unconventional alternative datasets. When traditional order book metrics get crowded, algorithms have to ingest variables from completely outside the standard financial ecosystem. The target of our study is the Chronos KP engine. This system uses microsecond planetary shifts, specifically transitions in logna cuspal sublords, as exact algorithmic entry triggers for equity indices. To a traditional analyst, extracting market timing data from planetary coordinates sounds completely indistinguishable from mysticism, but the origin of a dataset is irrelevant. Whether from satellite imagery, social media sentiment, or orbital positions, the only thing that matters is whether it survives an uncompromising, institutional-grade statistical audit. We will start by structuring the logic, applying Gann square of 9 mathematical mechanics to translate these transitions into strict risk parameters. Next, we run the resulting empirical data through a severe statistical gauntlet to filter out random noise. Finally, we deploy the validated model into a live multi-instrument cloud architecture. Treating alternative data with ruthless empiricism is the only reliable way to separate a true mathematical edge from curve-fitted illusion. Different market sectors exhibit distinct statistical personalities, which means they require specific variable mapping to generate viable signals. This sectoral astro-archetype mapping matrix details those relationships. For example, Bank Nifty maps directly to Jupiter, reflecting macroeconomic expansion, banking, and high beta liquidity swings. Conversely, Nifty IT maps to Mercury and Rahu. This alignment corresponds to algorithmic volatility, rapid gap movements, and foreign trade communications. The algorithm does not interpret these alignments subjectively. Entries are triggered strictly by exact planetary ingress transitions down to the microsecond, deliberately stripping all human emotional bias from the execution sequence. To actually trade these sudden transitions, the system requires a rigid risk management framework. We use Gann square of 9 harmonics. This visualization shows the foundational math of Gann harmonics. We calculate the square root of our exact base entry price, which expands into a geometric spiral of potential resistance and support levels. From that central base, precise price targets are projected outward at specific orbital intervals, most notably the 45-degree and 90-degree harmonic nodes. We calibrate stepped trailing stops directly to these degrees. As price advances through a 45-degree threshold, the stop loss ratchets up in a staircase formation to lock in profit. Relying on static, hard-coded percentage stops fails in volatile environments. Dynamic, mathematically derived harmonics automatically adjust to the specific structural volatility of the initial entry price. A smooth equity curve is meaningless without inferential statistical validation. We have to prove the results aren't just random luck. This dashboard shows our first hurdle for the 1,506 trade historical ledger, the chi-square goodness of fit test. The bar chart models our expected random win rate against our observed performance. Because the strategy operates with a 3.34 to 1 reward-to-risk ratio, the minimum baseline break-even win rate is only 23%. The chi-square test returns a p-value of 4.05 times 10 to the negative 37th power. The probability of achieving 555 wins purely through market noise is virtually zero. Our second hurdle checks whether the algorithm simply memorized and curve-fit a specific historical volatility regime. We use the Wald-Wolfowitz runs test, shown here on the scatter plot, which checks for serial correlation or suspicious clustering in the sequence of wins and losses. The test outputs a z-score of negative 0.3842. This confirms the trades are independent and identically distributed over the entire dataset. In plain English, the system exhibits zero serial autocorrelation or streak bias. It performs consistently regardless of the market cycle. The final hurdle is Monte Carlo bootstrapping to test for path dependency and to define our worst-case drawdown scenarios. This histogram visualizes the process of resampling the historical ledger 10,000 times, effectively simulating thousands of alternate market realities and trading paths. The simulation yields a 100% probability of system profitability across all 10,000 iterations. Every single simulated path finished net profitable. The 95% confidence interval for the profit factor rests firmly between 1.25 and 1.64. The mathematical edge is entirely robust under pressure. Surviving these 3 specific tests elevates the methodology from a hypothetical backtest to a verified trading edge ready for live capital deployment. Scaling a validated edge across multiple instruments simultaneously introduces an engineering problem. It usually spikes execution latency and inflates cloud compute costs. To solve this, we use the 3-phase modular execution pipeline shown in this flowchart, designed explicitly to operate on lightweight microcloud instances. Phase 1 is the universal data miner. It ingests raw CSV and Parquet files, computing CSL pivot points and statistical validations independently. Phase 2 exports a dynamic JSON registry. Instead of hard-coding rules, the miner outputs a dynamic profile, assigning specific bullish and bearish significators, targets, and stops to each ticker. Phase 3, the live execution bot, reads the registry and subscribes to a continuous 0MQ data stream. Because the heavy statistical computation was already completed in Phase 1, the bot simply matches live ticks against the dynamic registry without spawning heavy trialed processes. When an alignment triggers, the bot fires isolated webhook signals to execution platforms like Tradetron, while simultaneously pushing alerts to Telegram. The efficiency metric here is severe. This entire architecture operates using less than 200 megabytes of RAM, easily fitting inside a basic GCP E2 microinstance limit. Decoupling the data mining process from live execution allows algorithmic portfolios to scale infinitely across sectors, utilizing the cheapest available cloud instances without sacrificing speed. We ingested an unconventional alternative dataset, structured the risk using GAN mechanics, subjected the results to statistical scrutiny, and decoupled the cloud execution pipeline. The core philosophy of this process is simple. The origin of a dataset, whether it derives from supply chain logistics or planetary coordinates, does not matter to the quantitative engineer. It is all just raw information. The financial industry often romanticizes the discovery of secret datasets. The reality is much colder. Alpha is built through the construction of robust, unforgiving mathematical frameworks. The edge is not found in the uniqueness of the data. The edge is found in the ruthlessness of the testing process. Applying practical, rigorously audited math is the only reliable way to extract and execute an advantage in modern markets.